Welcome back to the Gray Report. Addison Lubert joining us on the Gray Report once again. You're a veteran of the podcast, been on quite a few times, so folks are going to be familiar with you. How you doing this week, Addison?
I'm doing well. Cold, but I'm doing well.
Yeah, it's winter. Feels like it is finally here in the Midwest. And it's about time because the whole multifamily market has been a little frosty this year. And that's the first thing I wanted to talk to you about. I mean, it impacts your kind of day-to-day here at Gray Capital, which, you're consistently underwriting deals, looking at new opportunities, looking at our existing portfolio. And one of the key inputs and metrics for any new acquisition opportunity is rent growth, and forecasting that organic rent growth over the next couple of years. And we've been working on our own internal forecasts, rent growth forecasts for Midwestern markets for 2026. Link to that report in the description below. But CoStar came out with an update to their forecast as well that I wanted to highlight because it was starting to track some similar numbers that we were seeing, but it's not necessarily great. U.S. apartments rent growth declined last month in its largest October drop in more than 15 years as an oversupply of units affects all parts of the country. And specifically, the national average rent fell to $1,708. A 0.3% decrease from September's revised figures of $1,713, marks the fourth consecutive month of no change or negative change in monthly rent, according to CoStar's Apartments.com data. When you're looking at an acquisition opportunity, but you're faced with assumption of flat, call it 1% organic rent growth, but expenses are growing at 2 to 3%, if not more in some cases. You might, conservative assumption might be 3. 2 is kind of a long-standing assumption for inflation. We obviously seen some prices increase significantly more than that. How do you look at underwriting a deal when there's essentially kind of flat rent growth and expenses are growing faster than rent revenue?
Yeah, I would say, it's been a while since I would say generic rent growth really factors into my day-to-day underwriting, or I shouldn't say generic, but at least above kind of a minimum 3% placeholder. And if there's really rent growth above that, it's, I would say, property specific and very less the broader market.
So just very location specific, but also like business plan.
Yeah, I would say
specific.
location specific. If there's some oddities within the rent roll of, one bed at this square footage is at 1,300, but a different floor plan, still one bed, still same square footage is at 1,400. There's sort of a let's see what we can do to narrow the gap.
Yeah.
Also taking a look at just where they've been trending on, where they've been signing leases for that floor plan as the year goes on, and trying to maintain a consistent level. But I think as we bring in AIRM and some of the different leasing tools, getting a better understanding of that makes that process is going to make it easier just to understand potentially, hey, how is another owner, how is the current owner viewing the current rent situation? So I would say it's mainly that. It's property specific. Another one that I tend to look at also is really the occupancy.
Mm-hmm.
When we're seeing properties that are 97, 98, 99% occupied, it's automatically just kind of in our heads of in any scenario, those rents are going to increase because you don't want to be, if you're sitting at 99, so what a lot of people say is hey, you're not charging enough.
Yeah.
So it's very property specific. And then I would say if there's any above rent growth beyond that, it's just where it is within the comp set. I think Flats at Stones Crossing was a great example of, you could look at its comp set in terms of what was in the actual town of Greenwood, but you spend enough time in that area, you drive the asset, you know that it's almost like it's, as much as it's a part of a community and it's a part of that comp set, it's kind of on its own as an island. And also factored in there how they were trending on leasing and getting a sense of how the current setup was with new leases. So I would say in general that rent growth has kind of in terms of where we probably were in 2021 or 2022. If we're getting people up to market, it for the last like year and a half, I would say it's been pretty much, let's see where things are at 3% before we do anything.
So what I'm hearing you saying is, well, one, that there's a lot of nuance in the process. You can't look at, Columbus, Ohio is growing at, forecasted to grow at 2% in 2026. Therefore, any property that I'm going to be underwriting in Columbus, I'm going to suggest a 2% rent growth. There can be an individual property story or a location or submarket story, but also what I heard you say is a mark to market opportunity of where, okay, if that organic rent growth is assuming like all rents are at market, but if a property has rents that are significantly below market, there's more room to be able to push it and still maintain kind of within the range of what the market will accept. So if 1% rent growth is a $20 year over year increase, but if you're $100 below the rest of the comps, true comps already, there may be a whole $110. You might be able to get that asset to, assuming that demographic, is willing to, you might not be able to get that on renewals because maybe someone might think that that's too big of an increase, but on a new lease, theoretically, you should be able to move that full kind of $110 up to market. Is that what you're saying?
Yeah, I would say that. I mean, the other part of it too is you kind of have to think about how we've viewed our own assets and how when we've taken a look, when we've done comp studies and found out, this property near Villas on Fur just moved rent $75 and the spread's tighter than we think it should be. Well, then we start looking at villas and how we could push things up. So
not always is what you're saying. In market rents can be a little deceiving sometimes.
It can be
Did they get one lease at that rate or 0 leases?
Right. So it's that, but also, can't get in anybody's head, but it's sort of like, okay, well, if they're getting in our heads, it's sort of like if they're getting closer to us, then that means there could be movement for villas or there's going to be an attempt to do it. So kind of factoring in the market of, okay, if we're, the best of the B class and we push rents up to here, you have to think those A class rents are going to start bumping too, because they're thinking, hey, a worse asset's getting closer to us and they're going to push that rent growth. Now I will say on the two things that I also have noticed more and more is not just the actual rent growth number, but what is the actual dollar increase? Because 3% in some cases could be $30 to $40. How many people are going to go through the process of moving out of the apartment complex if their rent goes up $30? And of those people that would move out, how many of those people are already kind of trending towards we're buying a house, going to a house to rent? How many of those people would be kind of looking to move anyway? Now, obviously, you don't always have a feel for that component in the underwriting, but the dollar amount now I feel like probably plays a bigger role, because like if 3% is an $80 increase, well, how many times can you move rents $80, especially? And then you start to ask, how many times can the market do that? Or
that's how people think. They don't think of in percentages. They're not like my rent went up, 3%, 5%, 10%. I mean, some may, but it's usually my rent went up $100, $200. It's always that nominal amount. Okay, you mentioned AIRM and the dynamic pricing, which I think is an interesting topic when it comes to underwriting or analysis and the way we're viewing the market, because so many more communities are using some form of dynamic pricing versus kind of the old school way was, we set the rents for maybe the year, maybe the quarter, and you kind of set it and forget it. And maybe you're readjusting those on an as needed basis. Maybe it's quarterly. But now at many of our communities, our rents are not just changing every day, but there's optionality within one unit. And so like, depending on if you want a 3-month, 6-month, 9-month, 12, 18-month lease, the rental rate is going to change based upon where we want that lease to expire. And so like if taking an 18-month lease has your lease expire in January, and I don't want that lease to expire in the dead of winter, we might charge a lot for that, that lease term versus if maybe it's a 9 month or a 12 month and it expires in the middle of the leasing season. Maybe that's exactly when we want it to expire, and we'll give you a little bit of break. But also like when you move in, if you're going to move in tomorrow, we'll give you a better overall rate versus if you want to move in 2 weeks or a month from now.
Yeah.
So that's great for maximizing the efficiency of our rent roll. But then when we go to like look at it from an acquisition standpoint of someone else who's been using those same tools, you could have rental rates are all across the board, and it could lead to inferring a certain rate is achievable when it was a unique situation. How has dynamic pricing, revenue management, AIRM, there's different systems that do it. How is that impacting your process when you're looking at a property?
Well, I will say for this, the further along I would go in the process is really determined in terms of like how close we are in the acquisition. To guidance.
If we're even like serious enough about the acquisition to go into all the details of how are you operating that system?
Yeah, the closer you are, it's worth it to go through that exercise to figure out just kind of what the patterns are. And what I would say is now the differences now to a degree can be explained through just the different settings that they have it set on. And again, trying to figure out, okay, did this person try and sign a 12-month lease if somebody's coming in July wanting to sign a 12-month lease, it's probably going to be priced favorably than somebody that's wanting to move in January and be expire in January, and how the system's going to treat it. So you're kind of trying to see, okay, there's a variance between, as I'd mentioned earlier, floor plans, same square footage, and yet there's a $300 delta in rents in the same year. What's going on there? And so you're, at least if what's available to you, trying to parse through the rent roll to figure out what's the lease term, what could be some patterns. I would say with the AIRM tools, it can be harder to spot patterns because you don't always know what settings the system was on. Well, I shouldn't say you don't know. And also the settings can change from time to time. If they had higher vacancy a year earlier, those settings change, then they get it right sized to 95. Maybe the market picks up, maybe just ownership management made the right adjustment and they're moving forward. Well, then the settings change. You're going to start to see more variance in the rents, and it's hard to pick the actual patterns. Now, what I will say with Solana, when we did this exercise, there was enough patterns in the rent where starting to try and forecast out what the rent roll could look like the closer we got to close, and it was like, okay, well, if we start taking people to market, all of a sudden they'd be significantly less than what they were at in their current lease rent. So then you're trying to figure out if you're holding them flat or what the situation is. But then it's like, why is this lease significantly higher than what the market is? But then again, same thing. Why is it significantly? So I would say now it's kind of getting out of the sense of you're still trying to find a pattern in the leases, even though I think at this point, the more people that are on AIRM, it's hard to detect a pattern. You're now kind of going more into a mode of what's the degree of variance and what's a high enough variance that you see consistently to say, okay, is this an AIRM thing or do they have broader problems?
Yeah, it adds a lot more noise into the process because not only again your own properties, what but again, what settings did they choose? Are they optimizing for 97% occupancy or 92% occupancy? And then you ask yourself, okay, well, if we change the preferences within the system, just what does that do? And the types of value add. It's not really a value add, but it's how could you generate more revenue by having just better settings on what you're charging? And I think we've seen at least one example recently of where I don't think we're going to be able to be competitive enough on the price. Hopefully we can, but it was starting to be clear that like there may be some inefficiencies and just on how they're using the revenue management system. And just if the system was optimized the right way, you don't have to paint any walls or renovate any units. You can literally just change the settings and start achieving more efficient rent in a higher overall total income. Your occupancy may change, but if you achieve a little bit higher rents, you can achieve, again, higher total net income.
Mm-hmm. The other thing I will note, and we talked about this a little bit the last time I was on, another big role that kind of plays into, I guess, how you look at rent growth is the concession amount and how they're doing concessions. Because
especially there's a lot of concessions going on right now.
if somebody has a month or two of free rent, you would hope, and more likely is the case that the renter knows that that's not going to be a thing moving forward. And on a 12-month lease, 10 months of paying rent, no discount, and it's at the stated rental rate. You go to do the renewal. Again, that's where that kind of the dollar figure comes in. If it's a dollar amount that they're okay with, they're likely to renew, and you're not going to have really a headache with that. It's where recurring sessions become an issue, because then that's where you're trying to figure out how many people are on recurring concessions, what's that amount, and then where I would try and grow rents the following year. How many people or how much of the property is going to say, hey, well,
that swing, it's not just $100, it's $200, because if they had a $100 concession plus the $100 increase, that's a big swing.
And if there's plenty of properties in the market that are cheaper at the same amount, it's easier for them to make that decision.
Yeah. And most people would underwrite, okay, I'm going to get some rent growth, and we'll also burn off concessions, not just we're going to burn off concessions and then the next year we're going to get rent growth, which is sometimes how it ends up playing out.
I think it's a function of the market, and also just having a better sense now for how the agencies would underwrite. I feel like when I talk with brokers, that's, as of now, probably the first question I'm getting to consistently is, what's their concession plan?
Yeah.
And is there a set strategy? Like, are they upping concessions now because they have some unexpected vacancy in October, November, December, and they want to try and track the few people that are looking to move during that months, and they want to reach them? Or is it a strategy? Because that's where it's really, one, trying to figure out what the strategy is to communicate to the agencies, but also, like, this isn't a recurring thing, is it? And if so, like, is there a plan to get off? Why are they doing it in the first place?
What are some other questions that you're asking brokers now that maybe you hadn't in the past, or you didn't need to, that are unique to the times?
I think to a degree, if there's sort of it really ties into occupancy and economic occupancy. If you see higher than normal vacancy, to a degree, there's just a sense of, like, I don't think there's anything wrong with it, but how did they get to a higher than expected vacancy? Was it that they weren't pushing rents, or is there something about the community that people just don't want to leave for?
Yeah.
Trying to get a sense of that. And then really anything that I think it's one of those things, if the more you talk with lenders, the more you can anticipate the questions they're going to ask you. So it's like, I might as well just
get this out of the way. Yeah.
And so I think it's, if you just really see a pretty high concession or delinquency amount of, okay, how much of this is a pattern? How much of this is just a weird, kind of blip on the radar?
Yeah.
But also, that's when you really try and dig into, like, what is the current ownership? What's the current management? Because it's not, the end of the world, but there are some times where you end up with some property management companies where, if they're experienced more in workforce housing and they're managing a brand new Class A asset, the strategies just don't align. Or if it's an owner and developer that is more in the affordable space that then goes to market rate, you can see that pop up. So I think it's really trying to figure out the patterns there. And then on the flip side of the occupancy, if they're lower 90s or kind of in the higher 80s, in an otherwise pretty healthy market, that's another one of, like, okay, I know I'm going to be told that it's a property management part, but what's going on? Is it that they just don't have a leasing strategy? And also trying to get a feel for ownership. Is ownership not real estate focused? Are they not, I don't want to say, do they not know what's going on, but are they in a situation where they don't even know the questions to ask? Just trying to get a feel of, in general, one, what stories we're going to need to communicate to our investors, but also mainly the lenders are going to ask. So
yeah,
trying to just get that information ahead of time.
Yeah.